Another 25 basis point interest rate cut for Canada today, and the currency took a dive, with the Loonie down over a cent. What does this mean for your portfolio? David Tulk, Chief Canada Macro Strategist at TD Securities, is here with me today. Well, David, they didn't say the R word today, but is this a recession?
I certainly will feel that way for part of the country. I would say that it's a very localized shock. Anyone remotely tied to the energy industry is probably feeling what it would look like to be in a recession. But there are other parts of Canada's economy, and here we can look at the housing market across several large cities as really going on quite nicely.
So what does that do then for the housing market when we see this cut?
Yeah, and I think it does provide just a little bit more stimulus. It's a concern that the Bank of Canada has cited that perhaps there's a little bit too much leverage creeping into the housing market. But from their perspective, they only have one policy tool to try to address a range of issues, and they clearly have prioritized the downside risk to economic growth, and that's what governed their actions today.
And I think the oil price shock was maybe a little bit worse than they expected.
I think it's actually a lot worse than they anticipated.
Worse, yeah.
So when you look at their first quarter growth, they missed that by about half a percentage point, and their tracking going into the second quarter has also been very optimistic, and in actual fact, with their forecast they revised today is more than 2% difference between where they had thought growth would rebound to now looking for a second consecutive quarter of a contraction in output.
So the currency, of course, took a huge hit today. Where do you see the currency going, I guess, from here?
Yeah, I think there's probably a little bit more downside in terms of the Canadian dollar, although I don't know how much of that will come from actions by the Bank of Canada or in terms of the Canadian data. I think the focus will shift relatively quickly to the Federal Reserve and their ambition to raise interest rates a little bit later on this year. And while the Bank of Canada was cutting rates, Janet Yellen, the chair of the Federal Reserve, was talking in front of Congress to basically express optimism in the U.S. recovery and really laying the groundwork for what we believe will be a September hike.
So that should help us hopefully down the road?
Exactly, yeah. I think the acknowledgement of a stronger U.S. economy by the Federal Reserve is an important precondition for growth in Canada. The weakness in the Canadian dollar also helps to make Canadian exports that much more competitive. So if you have a cheaper currency exporting into a faster growing economy, that should show up in terms of the Canadian economy. It hasn't to date, which is why the Bank of Canada felt the need to try and accelerate that process by providing a little bit more stimulus with the indirect impact of weakening the currency.
So are you thinking that exports then will improve? It sort of seems like there's been a delay and it's not really happening right now.
I think we need to be very careful in watching this process unfold. There are certainly sectors in the Canadian economy that are quite closely tied to changes in the currency, so they should start looking a little bit better over the next couple of quarters. But there are those that are a little bit more insensitive to the currency fluctuations and instead are far more aligned with the level of foreign demand. And even though the U.S. has struggled to start the year, as the U.S. should look a little bit better through the second half of the year, that should flow back favorably to Canadian exports. But keep in mind there's lots of growth uncertainty elsewhere in the world. China's actively decelerating its economy. The Eurozone, as much as we've pushed Greece to the side, the underlying growth picture isn't particularly upbeat either. So it's a very difficult environment for Canadian exporters to really capitalize on stronger foreign demand. So again, this puts a lot more pressure on the currency to try and do some of the heavy lifting to at least accelerate that process.
So are we looking for a little bit more tepid growth then going forward? I know the Bank of Canada lowered their forecast. What are you thinking?
Yeah, I think the tracking for Q2 at least, so very near-term outlook, I think will be as pessimistic, if not more pessimistic, than what the Bank of Canada has forecast. So that does leave some lingering chance the bank might be forced to cut interest rates yet again. But as we start to get maybe into the early part of 2016, our feeling is that growth should look a little bit better. But again, I think tepid is the right word to describe it, where any rebound in growth will be fairly sluggish and won't feel like a tremendously healthy economy. It will be more just the muddle through type scenario.
So what does the Bank of Canada look at? What does the governor look like when he sits at and sits down and tries to weigh all these decisions?
Yeah, I think he's facing a fairly difficult outlook. Again, he has one policy instrument that is calibrated to give different results depending on where you sit in the economy. His source of frustration is likely due to matters beyond Canada's borders. So for instance, oil prices, Canada isn't really a global price setter. We tend to be a price taker. So the issues of OPEC and with Iran coming back to the table with more production, that is certainly something the bank can't control, and all things equal likely leads to lower oil prices. Similarly, the health of the U.S. economy, the Bank of Canada really can't do very much themselves to help that process unfold. So it's that lack of optimism globally which I think does constrain him. So he will look at what he can control, which is, again, interest rates. And if he can try to at least allow the household sector to perform reasonably well in the face of this uncertainty, that is a step in the right direction, even though it may mean more medium-term challenges. Similarly, trying to make sure businesses have very cheap financing helps them on the margin feel comfortable in investing.
All right. And do you see the currency ever going back to par?
I think it may take quite some time. One never likes to say never in this type of business because a lot of different things can change going forward. But when we look at a very long time span of the Canadian dollar, trading at parity and above is really the abnormality. The Canadian economy is far better suited for a weaker currency that helps at least the manufacturing sector export into a faster growing U.S. economy and hopefully at some point a global economy.
No, hopefully this speeds us up anyway.
Entirely.
Thank you very much, David.
Thank you.
I've been joined by David Tulk, Chief Canada Macro Strategist at TD Securities. I'm MaryAnn. Thanks for watching.